The central bank lowered its key lending rate for the second time as the country's headline inflation softened to 3% last month. Today, the BOU announced a 25 basis points rate cut to 9.75%. That's a new low in policy rate level for this East African economy. Here are some takeaways from the post-MPC briefing by the governor. Take a listen.
On 7th of October 2024, the Bank of Uganda Monetary Policy Committee, MPC, reduced the central bank rate, CBR, by 25 basis points to 9.75% due to an improved inflation outlook. Inflation remains subdued, in part reflecting the unwinding of the global shocks, the stable shilling exchange rate, partly due to the steady coffee export receipts, moderate import growth, and prudent monetary policy that balance economic growth recovery while maintaining price stability. Over the 12 months to the month of September 2024, annual headline and core inflation averaged 3.2%. Specifically, annual headline and core inflation decreased to 3% and 3.7% in September 2024, down from 3.5% and 3.9% in August 2024, respectively. Notably, inflation declined in September 2024, driven by lower oil prices and reduced food prices. The decline in core inflation was primarily attributed to a reduction in the services inflation, particularly in passenger transport services. The Bank of Uganda projects average core inflation to remain below the medium-term target of 5% over the next 12 months, supported by the relatively stable shilling exchange rate and the favorable food and oil prices. However, inflation is expected to return and stabilize around the target in the medium term. The inflation outlook is susceptible to risks. On the downside, inflation may be lower if the previous policy actions dampen demand more than expected, the economic environment in the rest of the world worsens unexpectedly, favorable harvests that results in lower food crop inflation than currently projected, and a stronger appreciation of the shilling, partly due to stronger capital inflows coupled with softer global inflation. On the upside, heightened geopolitical tensions could push energy prices and freight costs higher and disrupt the global trade, resulting in higher domestic inflation. Also, the ongoing global developments could result in greater shilling exchange rate depreciation, causing inflation to rise sharply. Extreme weather events could also drive food prices higher than projected, and of course the higher domestic economic growth due to increased investments in extractive industries and effective implementation of the government's programs could result in stronger aggregate demand than currently envisaged, therefore resulting into higher inflation. Overall, we think that the risks to inflation outlook are balanced. GDP estimates for June 2024 quarter by the Uganda Bureau of Statistics, UBOS, indicate that growth has been strong, with an annual real GDP growth of 6.6%. High-frequency indicators of economic activity and business sentiments point to a continuing pickup in economic activity. Economic growth is still projected at 6 to 6.5% in financial year 2024/25 and 7% in the subsequent years. The growth trajectory is underpinned by strategic government interventions an increase in foreign direct investment in the extractive industry, and the commencement of oil production in the financial year 2025/26. However, the growth outlook is subject to several risks. On the downside, one, intensified geopolitical tensions could generate further economic shocks through disruptions of trade and supply chains, leading to higher commodity prices, especially oil. Also, elevated trade restrictions and debt levels in many countries could add significant inflationary pressures to the world economy, generating tighter financial conditions for Uganda. In addition, domestic financial conditions could remain tight, resulting in higher borrowing costs and subsequently private sector credit growth remaining sluggish. Higher domestic borrowing to finance fiscal deficits could crowd out the private sector and exacerbate the already constrained private sector credits. By contrast, growth could be higher if inflation drops much lower, raising confidence and real incomes, which will result into stronger demand. And also if the world economy grows more strongly than expected. In addition, if investments in the mineral sector is higher than anticipated, also a more favorable weather conditions, which would yield good food crop harvests, together with monetary policy conditions which are more accommodative. Overall, risks to the growth outlook are balanced. The MPC therefore assesses that inflation is expected to remain below the target in the near term, and that the risks to inflation are balanced, but acknowledges the inherent uncertainty in the outlook, which warrants a cautious monetary policy stand. Against this backdrop, the MPC reduced the policy rates by 25 basis points to 9.75%. The bands on the CBR remained at plus/minus 2 percentage points, and the margins on the CBR for the rediscount and the bank rates at 3.4 percentage points respectively. As a result, the rediscount and the bank rates have been reduced to 12.75% and 13.75% respectively. The MPC notes that easing of monetary policy is necessary to keep inflation on track while supporting socio-economic transformation. Any additional changes to the policy rate will continue to rely upon the incoming data and the evolving assessment of risks to guide its decision.